Welcome to this fully worked example that I'm going to go through. It's called, well, I've called it Platinum PLC, and it's a exercise that perhaps you want to spend a bit of time understanding, because there is a question in the exam that follows this sort of format. So my intention here is to show you on the right hand side how this question might present, and then on the left essentially a blank spreadsheet on how we proceed. What do we do with this data and how do we put it into a format that is useful. One of the things I like to do before I even read through the data is I scroll down here and I look at the questions. Prepare a performance budget for Platinum PLC for the 2-month period commencing 1 December to 31st of January. Okay, so some sort of budget. I would expect that some income and expenditure, and that might look like an income statement. Then it says prepare a debtors collection schedule for Platinum PLC for the 2 months, 1 December to 31 January. Alright, so debtors collection is we've made some sales, but customers pay at some time in the future, and we want to find out in these months how much do we collect from those sales. Alright, and the last question, prepare a cash budget for Platinum PLC for the 2 months. Okay, again the same 2 months. Okay, so why would they ask a cash budget as compared to a performance budget? Because this performance budget might look like an income statement that doesn't care about when the customer pays or when we pay the supplier. A cash budget that cares about when the customer pays us and when we pay our supplier. Okay, so we've got an idea of what's going to come here. Let's head back up here and read what it has to say. The following information has been taken from the financial records of of Platinum PLC. The bookkeeper prepared the following basic budget for us for 31st December and for January 2021. Alright, so my instinct as soon as I see something like this is I'm doing December, January, let's get some spelling right here, January, and there's a sales number there for December, so that's 380,000, and a sales number for January, 388,000. Okay, just collecting data as I go through the question. And in fact, I'm going to go all the way over here and I'm going to say, well, this is sales. Give it a name. Okay. Then they say there's some purchases of stock. Okay, now intuitively, when I see that, I know that to calculate a cost of sales, I'm probably going to need to do a little calculation that goes like this: opening stock plus purchases minus closing stock. Minus closing stock. Well, let's leave the minus out because Excel is just saying it doesn't like me doing that. Alright. And they've given us some purchases for December, so I'm just going to plug this in here, 180,000 and 186,000. Okay, again, just plugging some numbers in. The bank statement showed a credit balance of 11,500 on the 1st of December 2020. Alright, so I'm just going to make a note here, just for the hell of it. Cash, and that was 11,500, and this date here is 1 December 2020. I don't know how and where I'm going to use that, but for now, let me just plonk it in there, and I can move it when I need it. Platinum PLC reported the following actual total sales for the 3 months ended 30 November 2020. Okay, NB, 80% of the sales are on credit. Alright, so they're giving us some historical sales here. So what if we came back here and we said September, October, and November. Remember they said to us that we're going to have to do some debtor days type of debtor days, prepare a debtors collection. Well, they're setting us up here because here are 3 historical months and we're going to have to do some debtors collection for these months. It's going to be based on historical sales because that's what debtors are. Okay, so let's plug in here some numbers. They tell us that we did 270,000 over there, 330,000 in October, and 390,000 in November. Okay, let's tidy this up a little bit, put it in bold, say to Excel just widen these columns so we can read what's going on in there. I'm going to make this a little bit more user friendly so that I can got some number spaces. I don't need the decimals, it's easier to read the numbers. There we go. Okay, 80% of the sales are on credit. Okay, I'm just going to make a note here for now. Credit sales, and I simply am going to say 80%, give that a percentage, and I'm going to just copy and paste that for each of the months because I think I'm going to have to use that for every month. Next up, credit sales are allocated as follows. Okay, I'm reading over here, point 3. Credit sales are allocated as follows. All right, so if this is the credit sales, let's see how much the cash sales are, and we know that that must be 20%. Turn that into a percentage and we can copy and paste that right because the sum of those two must be 100%. Okay, that's not told to us, but we must infer that. And then it says 30% of the month of sale. So can we call this, let's just call this current. And in the current month, 30% of the 80% of 270,000 will be payable in this month. Okay, and then in the next month on 30 days, let's call this 30 days. 30 days is 40%. Okay, 40%. Then 60 days, oopsie, excuse me, let's write this, 60 days is 28%. Okay, let's just get rid of that, and we want to format these two cells, Alt HP, percentage, there we go. Alright, I think we are going to be using that data for every month. Okay, so let's just think about what's going to happen here, what I'm processing. We are going to do some sales in September. 20% of those sales are going to land up here as cash sales. Cash sales. Okay, I don't have to read the question to know that this is useful data. I can go hunting now or do some calculations. 270,000 times 20% says to me, right, that's going to be cash sales. That is going to be the case in every single month. All right, now just think about what's going on here. We're going to have to do a cash budget. So in our cash budget, we're going to need some cash sales. All right, in our debtor collections, well, we want to know, this is not so much debtor collections, but definitely these next 3, I'm going to copy and paste those there. What's the current portion that's due for September? So you're going to take the sales, you're going to multiply it by the portion that's credit sales, and then you're going to multiply it by the 30% that is current and therefore due now. Okay, and that's going to happen every single month. There's going to be a current portion. Alright, so there's the current portion for December, and there's the current portion for January. Cool. So there's the cash and there's the current. Now, there's a 30 days portion. So I'm just going to fast forward 30 days. And I'm going to say in here must be those sales times 80% credit times 40%. In fact, to be strictly correct, doesn't really matter. Let's keep these all aligned just for the purpose of alignment. And now we've calculated the portion that's sold on credit and the proportion that is paid in 30 days, and that's been shifted forward a month because that's when we actually receive it. Now if we copy and paste this 1 month forward and test this, same principle applies. Okay, so our spreadsheet's working fine. Okay, there we go. Then there's a 60 days collections number, so that one will come over here, and this one will be based on sales from 60 days ago. Again, the credit sales portion is the portion that counts, and then the 28% is the amount that we collect there. Alright, and we can copy and paste that. Okay, so you see what is starting to emerge here just in these three numbers is the debtor collection schedule. Okay, that's starting to take shape for us. Alright, now let's just see what we've used and what we haven't used. We've used our selling data, we've used our collections data, we haven't used the 2% write-off after 90 days. Okay, so let's just put that down here. In fact, I'm not going to put it here. I'm going to put it here. We're going to call this a write-off, and this is 2%. And let's convert that into a percentage. And effectively what they're telling us there, control right, what they're telling us there is on 90 days we are going to have a 2% bad debt. So 90 days is 3 months. Is that right? 1, 2, 3. We can put in here a bad debt expense for December. This is going to be the sales done here multiplied by, you can only have bad debt on the credit sales, then multiplied by the 2% bad debt charged on 90 days. So there is an expense. If you move that forward one cell, let's see what happens. It's the next month, 80%, 2%, and we are 1, 2, 3 months ahead, 90 days. Happy days. Okay, what's up next? All purchases are on credit. All purchases are on credit. Alright, so that's all these ones are on credit. That means we get the goods today, we pay later, and are paid 2 months after the expense occurred. That's 60 days. Alright, credit purchases for September, October, November amount to, and they're the amounts respectively. Well, let's plug them in. September's amount is 162,400. Next one, 166,900. If you're dyslexic like me, concentrate hard now. If you've got fat fingers, concentrate hard that you don't put the wrong numbers in there. Okay, so now we've got a whole lot of purchases. Great. Stock balances at the end of November, December, and January was, there are the numbers. Okay, so we've got a stock balance for the end of November. That's a closing stock number. Let's plug that in. That is 11,800. Next one is 16,400, and the next one is 15,600. Okay, so now we've got some closing stock. Now this comes from a little bit of experience, and maybe you know this already, but the opening stock for the next month must be the closing stock from the month before, and that is true for the next month. That one is that number there. Now we know that cost of sales is equal to opening stock plus purchases minus closing stock. Beautiful. We now have a cost of sales number. You see our question 1, preparing the budget, is starting to come together. That's essentially what this is. Now we can calculate a gross profit, and you all know that sales minus cost of sales gives us a gross profit, and we have gross profit for 2 years. So as you see how this is emerging, I'm kind of answering all 3 questions together as I use all the data. Okay, we've used everything here. Maybe not the cash, we're going to come back to that, but we've used everything in point 2, everything in point 3. We've used the purchases here. But one part we haven't done is the cash flow from these purchases. So let's just do a little cash in here while we're thinking about it. Let's do a cash. In fact, this is going to be cash out, not cash in. And we're going to call this purchases. All right. What they're saying here is that 2 months after it has incurred the purchase, we pay for it. Therefore, I'm looking at my December column for purchases. The outflow of cash here will be the purchases from October. All right, and if I copy and paste that right, the outflow here will be the purchases from November. Okay, now what's happening here is our cash flow statement is starting to emerge. We've got some pieces in there. Next up, new delivery vehicle will be purchased on 1 December for 150,000 and depreciated at 10%. So let's put here new delivery vehicle for December at 150,000. Okay, we need to just do a little bit more formatting here because we haven't done that. Okay, so I just wrote that number in because it's depreciated at 10% per annum. Let's put a percent there. Okay, Alt HP. Oh, sorry, I deleted what was in there. 10%. Change the formatting. Alt HP. There we go. All right. Platinum PLC will finance a deposit of the vehicle of 50,000 with a loan from PNP Bank. Okay, so let's put here deposit 50,000, not percentage, Justin, 50,000. All right, and to finance that, they are going to get a loan of also 50,000. All right. Then the remaining 100,000 rand, they will settle the remaining 100,000 rand with 4 equal monthly installments beginning 31 December 2020. I'm just going to say installments equals 100,000 divided by 4. Right, and in fact we can copy and paste that right. There we go. The loan bears interest at 15% per annum. All right, interest with a T at 15% per annum. HP. Okay, that's important. That is an expense, and the depreciation is an expense, and we need to put those up here. So let's put a depreciation expense in here. and the depreciation expense is going to be equal to the value of the vehicle all the way down there, 150,000, times 10%, right? Push enter, careful, 10% per annum, we need it per month. Okay, depreciation expense done. And for the purposes of making my spreadsheet work nicely, I'm going to put an anchor on that, and I'm going to control right. Okay, depreciation expense. Next up, this will be the profit before interest and tax, which will be our gross profit, there it is, minus that expense, bad debts, minus the depreciation. Great. Now we're going to put in, let's create a little bit of space here, put in an interest expense over here. We need to go and calculate that. Alright, what's the loan? The loan is there it is, 50,000, and we're going to multiply this by the interest rate. Enter. Careful, this is an interest rate per annum, so divided by 12. And then if I say put an F4 on there, you see it puts the dollar signs and an F4 on there. Dollar signs act as an anchor, which allow me to copy and paste this right, and it means it's referring to these cells, and when I copy and paste right, it doesn't move off them. Okay, good old basic Excel stuff there. We can copy and paste our calculation, just check that that works. Alright, now we've got a profit before tax is equal to 199,030 minus the interest. We have a profit before tax. We can do that for both years, and what have we done here is we have created a performance budget for Platinum PLC for the 2 months commencing 1 December to end of January, sorted. Alright, it's just a product of working through the process. Next up, a few things that we haven't done yet. Prepare the debtors collection schedule for Platinum PLC for the 2-month period commencing 1 December. Now I'm going to suggest to you that this here, current 3060 for these 2 months, is in fact the debtor schedule. So why don't we just add a line in here, and we're just going to say that this is our debtors schedule. Okay, you might put it in bold because you want the examiner to say, hey, there's a debtors schedule, and we were required to do it for December and January, so I'm just going to simply add that up there, and we copy and paste those right, and maybe just use a couple of lines here just to highlight that, hey, there is this here, Mr. Examiner, is my debtors schedule. Alrighty, cool. Now we've done part B. The part that's missing is part C, and that is to prepare a cash budget for the 2 months. Okay, so in a cash budget we are going to have something that says cash in, alright, and something that says cash out. So we've got something developing here. Let's add a few here. Insert. So some of this is a little bit of repetition, because in our cash in, I'll put that in bold, we are going to definitely have some cash sales. We're going to have a current collection. We're going to have a 30-day collection, and we're going to have a 60-day collection. So those are definitely going to be true. So this is actually somewhat of a repeat of what's already here. It's an exact repeat, but our debtors book is going to help us with our cash collection. But there's a few other things that went on here, because part of the cash in was that we got a loan from the bank, and that over here was this 50,000. Right. Now I think that's it. Okay, I think that's it. So this, we have to do a cash collection for these 2 months, and the loan was there but not there. Now we can add these up. So there's our cash in for those months they asked for, and now we're going to go and do a cash out. And part of the cash out was some purchases. We've already done that. Fantastic. Let's just check that. Where did that come from? That came from back here a couple of months ago. Let's just squeeze this up a little bit so that we can see what's going on here. Alright, so our purchases came from back there. That looks right. And this one came from back there. Yeah, that's good. Purchases. And then we got we paid a deposit, didn't we? We paid a deposit, and that deposit was paid in this month. So that, as you see, this is like a cash in, cash out. We got a loan in of 50, we paid a deposit out of 50. We did some purchases. Alright, let's add a little bit more space here. Other expenses, well, we paid some interest. Interest is payable in the month, so we can come up here, there's the interest payable. Okay, and that's the same for the next month. What else did we pay? Oh, the installment. Let's not forget the installment. Okay, we had to pay one portion of the 100,000, and again we had to pay an installment in the next year. Right, how is this looking? This purchases number doesn't feel right to me. Yes, this purchases, sure. Now carefully don't make this mistake. Some of you are probably shouting at the video a moment ago when I said let's go and check this, and I was saying purchases coming from sales. That's not right. Purchases comes from purchases. My goodness, you see, I'm not even under any exam pressure here, and I still am making an error. So imagine a little bit of pressure, how you can make an error here. So the thing is, just try and stay calm, keep thinking. Now, you didn't want to put the sales number in there, purchases number. Alright, now I think we have something coming together. Okay, there we go. That is our cash out, and it'll sum there for the next year, cash out. Alright, cool. So now what we can do is we can say we now have a net cash flow. What is a net cash flow? Well, it's cash in minus cash out. Therefore we have an inflow for 2 years. Alright, we need to make a little bit more room here. This is now coming together. Remember this piece of data that we stashed up here as the cash on hand? This is what we're going to call opening cash. Alright, so we're going to say this one is equal to that number. That's our opening cash. Therefore our closing cash at the end of this period is going to be the opening cash plus the net cash inflow. Fantastic. And if this is the closing cash, it will be the opening cash for the next month. And we can do the same calculation here, and now we have a closing cash number, and this is our kind of magical end to the cash flow. We'll just put a big black box around that. Sure, let's just check. What have we done here? We have done prepare a performance budget for the period December and January. Well, there it is. You can add some structure to this if you want to make it a little bit more user friendly. I'd like to put a little box around the cost of sales goodies calculations, just an outside box, give it a little bit of structure. What this is doing is it's just making things a little bit more user friendly when the examiner is trying to find stuff in your answer sheet. And if you're able to just point a few things out and add some structure, there we go. Alright, prepare a debtors collection schedule. There it is. It's got a name, and we've got collections over the last 2 months that they asked for, and last of all, a cash budget. And here we've got a cash in and a cash out, and we've got all the answers we need, and we are happy days. Alright, so try and do that on your own. Maybe you've seen me go through this here. Try and read through the question, try and process it yourself, and good luck with that.